Welcome, everybody. Thank you so much. Again, this is not a formal setting or anything like that. This is just a yearly event that I wanted to host, and I just wanted to give you, how my thinking has been over the years and what to look forward in the future. And the agenda for the meeting is really like I would like to reiterate in some cases, or just to give an idea to the new participants and new clients they've recently joined, what we're looking for and how we are approaching the investments in the business landscape, given that uncertainties are nothing new. It's just it's always there. So maybe in the first 15 minutes, I'll just talk about general things of the principles and philosophies and the type of tests that we put through each of the business and investments that we make. And maybe I'll share half a dozen of the investments that we hold in our portfolio at a very, very high level. And the highlight is really taking your questions. I love to hear every possible questions you may have. And the tougher the question, the better it is for me to contemplate, to come up with the better answers. And there have been few people who are not able to attend the meeting, so they have sent me a few questions, and I'll also address them periodically as we go through. Let's say, without further ado, let's go ahead and I'll share my screen. And let me first start out with the investment philosophy of how and what we're really looking for, so that the clients and potential clients they're clearly understand where we're going or how we're approaching investments. Many of you are ardent principles of value investment, or Buffett and Ben Graham. So many of you probably understand or knew all of this. Still, I like to reiterate in some cases. First one is from Benjamin Graham. So any investment which promises safety of principal and an adequate return, that's exactly what we're looking for. And if an investment comes along, it doesn't meet any one of those, it doesn't fall into our category of whether we can make investment, which are called speculative. And Warren Buffett's famous analogy, rule number 1, never lose money. Rule number 2, never forget the rule number 1. And those are the only 2 rules. And Peter Kaufman, some of you probably understand or know. Peter Kaufman is the one who wrote Poor Charlie's Almanac, about Charlie Munger's biography. And he literally talked about how we look at the investments. We're looking for investments or businesses which have very low risk and potentially above average return over a long period of time. That's exactly what we're looking for. We're not looking for any one of them, we're looking for all of them. Low risk without an above average return doesn't mean anything. Low risk and above average return on a short duration doesn't mean much to us. So all 3 has to play out to give us an adequate return for a long period of time. Essentially, what I'm trying to say is when we buy a stock, we're owners, literal owners of the business. The portion of the business that we own relative to the business may be very small, but that's what we have an inclination to think as a part owner. And given that we don't control these businesses, we like to buy it at a price which has some sort of healthy margin of safety to given the unknowable future. Although we try to predict as close as possible, given that the future is always unpredictable. We cannot not talk about risk when we're talking about investments or businesses. When people talk about risk, they talk about a lot of things. The risk doesn't have meaning on its own. You have to add something to it to make a meaning, right? You can talk about a product or service obsolescence risk. Yeah, that now the risk is very clearly defined. There are plenty of risks, right? You can see it: competition, the business can go bankrupt, or management can screw the shareholders. and the maturity of the business is perpetual in nature. So if our investment time horizon is not in sync with the business, that becomes a risk. And the fraud can be a risk, and not making enough return can be a risk. And inflation or interest rate can inadvertently affect our business and investments. And one of the most important ones is competition. The type of businesses that we invest in, what the competition can do can be a meaningful risk to our investment portfolio. But there is one risk people usually talk about when they say a risk. That's what they really mean. It's called market price volatility, which I made it kind of red. It's kind of funny that that is probably the only risk you cannot neither quantify or what I'd say like not participate, not take on it. You have to take that. That's the only risk. Like you cannot say, you know what, I don't want to take that. You have to, as a market participant, even a long-term investor, especially a short-term investor, which doesn't apply to us. Market price volatility becomes a huge risk for them, but not to us. Incidentally, all the other risks which I mentioned, which are very important to us as long-term shareholders, incidentally, those risks are actually both quantifiable and avoidable if you don't want to take it. Think about it. Like a bankruptcy risk can be totally avoided if you own a business with sustainable business model, with overly conservative balance sheet, with a net cash on the balance sheet, no debt in some ways. So you can totally avoid that. And product or service obsolescence can be avoided. Competition, somewhat you can avoid that, but you can take a dominant business and that has some sort of durable competitiveness that kind of resists to the natural competitive elements over time. And inflation, interest rate, again, you can avoid that if you want to go into a business where they have some sort of pricing power, where they're able to sell a product or service above their cost. That's how you would want to avoid the inflation or interest rate risk. The other way you would want to avoid is maybe you don't want to go into a very, very high capital intensive businesses, although they do have some sort of a monopolistic advantages in some cases, capital intensive businesses. But as a long-term owner, you're far better off going with a low asset intensive business than a capital intensive business. Adequate return, you can again avoid it or kind of participate in it, provided the price are attractive relative to the potential future. And the fraud and the management, they kind of go hand in hand. The management, the type of businesses that we invest are generally they exist. They're like well-oiled machine for a long time. So you kind of know the reputation, you kind of know the culture in the business and how they treat their suppliers and customers and the competitions and even shareholders. So you can kind of see whether there are any holes in those kind of areas. So if there is even a small possibility, we can just totally avoid that. And maturity risk doesn't apply to us given our long-term nature of our ownership. So we have almost as long of a timeline in terms of perpetuity close to the business ownership itself. So this is the risk section I do wanted to highlight, and market price volatility is the only one we totally cannot avoid. And given the long-term nature, it's really not even, we don't even perceive that as a risk. Given that risk and the philosophy, and these are the three-pillar approach that I would consider, that I put the test on the new investments that we come along. The three pillars are really, really simple, very commonsensical approach. The first one is the business itself and the management and the price that we pay really. When we say business, like what we're talking about business in the sense that whether the business is simple and predictable in nature. When I say simple, I'm not talking about easy. I'm talking about a simple, it could be a product or service, some sort of economic characteristics that we can clearly see with a detailed study. If they're simple enough, in some cases, you can predict the future within a zone of reasonableness in terms of our degree of confidence that we can predict in the future. And The business needs to be conservatively financed, given that the businesses in general inherently risky, but they're fragile in nature. Look what happened last year with the COVID. And if your business is not conservatively financed for that kind of a potential, and you would have had to issue lots of bonds and stocks last year to dilute our existing ownership. And conservative finance is very important characteristics. And another the important ones is the business earns a good enough of a return on invested capital. And we will talk about what is a good enough of a return on invested capital, maybe in a few minutes. So that's what we're looking for in a business, somewhat a competitive business. It resists a competitive elements of the business nature, and somewhat predictable and very soundly financed, and earns good enough return on invested capital. That's what we're looking for. They're rare, and as the very few businesses have that kind of elements. The second one is the business is so good, the only way the business can get screwed is the management. But if you can combine that with a talented and trustworthy owner with a lot of their money attached to it in a business, so they would act in the best interest of the shareholders for a long term. And that's what we're looking for. One without the other is no use, whether the management is talented or just trustworthy. The talented and the trustworthiness makes the manager useful to our journey in this case. The price is one of the most important elements. Regardless of how wonderful the business is, how great the management is, the price has to make some sense relative to the potential future. We don't want to pay infinite multiples to justify the above combination. So this is a general list of tests that I put through the businesses and investment that we choose for our portfolio. Usually we own these businesses for a long term, and I'll share a few of the investments that we own in the next slides. But again, I don't want to go in very detail in these businesses. I have written some of the details over the years, and especially if you attended a couple of years before the annual meeting of 2019. And majority of the businesses, you would say, oh yeah, we talked about that. Because our approach hasn't changed, these businesses opportunity hasn't changed. And they're still very good investments given the price and the potential future. Let's go ahead and put these individual businesses to the 3-pillar test to see how they rank up. As some of you are probably already very well aware of this business, we own this for more than 4 years now. The company is Grupo Televisa. The company is domiciled in Mexico, and majority of the operations in Mexico. And if you think about Grupo Televisa, this is almost a replica of Comcast in the US, Comcast Xfinity. And they have a cable operation, they have the content production, cable broadband. They have a content and broadcasting side. And then they also have a satellite operation, which again, a distribution. They also have a hodgepodge of other small businesses, which they have historically developed over the last 50 years. And some of them good businesses, some of them are not so good, but they're very, very small part of the whole pie. And the real gem among the group of businesses is the first one, cable TV and broadband. And even within that cable TV and broadband, the broadband is going to take the cake over time in terms of the usefulness to the customer, and the competitive forces negates the competition potentially in the future. And given the long-stated nature of these assets, has incredible benefit to the customer, so they can price their product without having difficulties of making any money. And to give you an idea, they have 5.5 million broadband customers. They have 16 million homes passing. So you're talking about less than 35% passing, compared to, let's say, a Comcast here. They have 47% penetration relative to their passings versus home. And they also have 4.2 million video customers and about 4 million telephone customers. It's a triple play. They sell it as a triple play package. But the telephonic customers and the video customers have been what I would call not struggling. They're not been growing as much as they used to because they are reaching what I call a saturation point. But the broadband internet customers they're growing incredibly well. I'm talking about high single digit to a low double digit on an annual basis. Especially last year, it kind of forced beneficially for us. It forced the customers to join and accelerate it. Given that Mexico has less than 53% penetration in fixed data internet at home, the majority of the customers are either they don't have internet or they have a very low speed mobile internet, which they pay atrocious prices for the speed and the data, the size of it. The content and Univision division, I don't know how many people read some of the updates that I provided over the years. So that business is actually in the process of merging with the Univision US. So they're giving that content and Univision division and merging with the Univision US. So they're going to get an exchange of 45% of the total company, which is going to be privately owned, and they would list it eventually. They say maybe in a few years when the time becomes prosperous. The satellite TV is a typical satellite TV distribution, like a direct TV type operation. They actually have a joint venture with the direct TV. They have more than 8 million customers, and they're actually selling broadband in the rural using that satellite connections. They have over 200,000 customers in the last few years. They've been growing it very slowly though. The other businesses that I talked about, these are historically old businesses like magazines, casinos and lottery, and film distribution, radio broadcasting. And they are very, very small portion of the pie. I even say less than 5% in terms of sales, maybe even less than 3% in terms of profits. So they are irrelevant to the bigger picture, but they're still worth some money. So to give you a consolidated revenue and cash flow figures, they have more than 5 billion in revenues, and the cash flows are more than 1.6 billion. This is a pre-tax operating cash flow. Majority of the cash flows are reinvested, obviously, to expanding the footprint on the broadband network, which would yield significant results over time. If you think about the broadband, it's the revenue today, given the low penetration and the low average revenue per user. So the return on capital doesn't look good relative to the capital they historically put in. But over time, the bandwidth gets increased, average revenue per user gets increased. The cost doesn't increase a lot relative to that. So majority of the cash flows that they generate are going to be free cash flow. And the return on capital is going to be very, very high and sustainable in the long term. And even expanding the bandwidth is very, very cheaper in terms of coaxial fiber combination to fiber itself. And provided the ARPU increases over time, they should be able to convert that into a total fiber footprint. The company today actually trades for a little more than 6 billion, about $11.50 a share. So we're talking about a little less than 4 times of operating cash flow. And the business have unlimited potential to grow over time, and they will grow, and they would allocate the capital well. Emilio is the CEO, founder's son. He's running this business for 25 years, and he has an impeccable record, both in terms of integrity and talent. And you can see that with some sort of association tendencies. So Grupo Televisa is very close with John Malone and team. That kind of gives us an idea in terms of talent and integrity part of the partners. So we have no doubt that they possess both of them, and we're very excited to be partners with them. And we like to be owners for this business for a very long term. And so far, our ownership is a little more than 4 years, and we like to be owners for a long term. Second business is Biglari Holdings. I have shared this idea over the years, and the CEO is somewhat, I would say, controversial in nature, but the people's judgment is very, very misplaced. I have met him in person many times. I've attended half a dozen times annual meetings, and he is as smart as a CEO or a capital allocator can come along. And we were very happy to have him as as a CEO, chairman of the company. Interestingly, let's take a look at the holding company that he built over the years and what kind of assets that they have. And 100% of Steak and Shake operation. Predominantly, it was company operated 10 years ago. They eventually moved to the franchised ownership partner structure, and now they even going franchise partner operation. And that's similar to what I would call a Chick-fil-A operating model relative to you operate the business. You attract a single-minded, single location owner operator, and they give them 50% of the profits potential to them. And then you charge them for almost everything, and you take 50% profit. It enormously eliminates the execution risk, enormously eliminates the capital needs of the business over time. And still, there are 230 locations company operated. Eventually, they will move into the franchise partner operator or eventually franchised. And today, last year, they went through a struggling times given the low volumes and COVID shutdowns and things of that nature. But in general, the business has some sort of, I would say, 25 to 30 million of operating profit potential, given, I would say, about like 50 to 70,000 per location operating profit potential. And they also own 100% of West End Sizzling, which is primarily franchised, except like 3 owned locations. They have profit potential of 2 million annually. And there's 2 insurance businesses that he has historically bought. First one is a First Guard, second one is a Southern Pioneer. And underwriting pre-tax profit combined, they could have like 12 million. And then they have investment portfolio about 100 million or so attached in that business. And he has bought Southern Oil a couple of years ago when the oil prices were down and somebody wanted to get rid of the asset, and he bought it. And that has a potential of, that actually not a potential. Last 4 quarters, they've generated something like 8 million in pre-tax profit. This is after depreciation, and almost all the cash flow is retained. They're not drilling any more new wells or anything like that. And the Maxim magazine produced about $1 million. And interestingly, they own a large marketable securities in 2 or 3 different businesses. The large one is a Cracker Barrel, which is 8.4% stake. Today's valuation, that's worth about 300 million. The pre-tax profit, they make about 21 million on a pro rata basis. Other marketable securities are owned, Berkshire Hathaway stock and a couple of other stocks. They constitute about 120 million in worth. The company also incidentally owns 64% of its own stock in treasury, although they are legally outstanding, but essentially we own it. If you think about economic shares, there's only like 34% of them are economically shares outstanding. The company neither have debt on the holding level or at the subsidiary level at this point. The company today trades for $230 million, adjusted for the treasury shares that I articulated before, about $170 a share. Any way you cut it, based on today's profitability and obviously potential future, this is a very, very, very attractive opportunity. And we have very high hopes, and we like to be, again, owners in this business for a very long term. The third business is, again, another Mexican company. I have written about this. Maybe I'll write about this again in this quarterly reports. And this business has been in existence for almost 70 years, in the public market for 25 years so far. And this is the largest chicken producer in Mexico with a 35% market share. And to give you an idea, 35% market share is 1 out of 3 chickens that you possibly buy in Mexico, that's their product. That is some dominance. And they didn't do it overnight. It took them 50 years to get to that decision. And it tells you how difficult it is to get to that market share or displace somebody who has that market share. The second largest guy has 5% market share, which is a Purdue chicken producer. That's 7 times bigger than the second guy. It's really, really have very high scale, which you can see that in operating margins from even on a very, very poor time, 2011 or 12, everybody else lost money. They made 4% operating margin. This year, they're probably going to have one of their best years, if not the best year, in terms of operating margin. They're going to have more than 10% in operating margins. I don't think that's sustainable. This is somewhat of an anomaly year, given that supply and demand of their product is being out of whack, and they're going to make a lot of money. And incidentally, they own almost half of their market cap is in net cash today. So to give you an idea, they have $2 billion in market cap, and they have almost $1 billion in net cash today. And it will get added. They have 2 more quarters left in this year. It will be much more than 50% of the market share if they do nothing, if they kept it in their balance sheet. So for $2 billion, you're getting a business with $1 billion in cash and about $4 billion in revenues, about $400 million in operating cash flow. I would say this is by far the dominant and attractive business that I've ever seen in my career. I would say in the last 15 years. Usually you can find these businesses cheap. They usually have some sort of trouble. Either they have like a leverage position or a weaker competitive position, or some sort of a difficulty in the industry. But this is an anomaly. The founding family controls 73% of the business themselves. So it's in their best interest to not to throw away the money, good money after bad. They're very disciplined, which explains the 1.1 billion, almost 1 billion in accumulated cash on their balance sheet. Again, we own this business for a little more than 5 years now, and the stock actually hasn't done anything in that 5 years, but the business has compounded almost as exactly as I would have predicted 5 years ago. So it's all good. If anybody looked at the stock price, they don't know what's going on. We have no interest in looking at the stock price as a judgment whether the business does well or not. We're looking at the business to look at whether our investment does well or not. And I almost would guarantee you in the next 5 years, if the stock price doesn't go up or goes down, we would like to increase our position even bigger than we already are. Just to give you an idea of how excited or happy to be partners with this in this business. The fourth one, probably the people's favorite or less favorite over the years now. It's Berkshire Hathaway, run by Buffett and Munger for over 55 years. And this is by far the largest insurance reinsurance company in the world by premiums and underwriting profits. You may think of like many businesses like a large, but they're nowhere close. And it's supplied by large collection of both 100% operating owned businesses and large collection of publicly trading equities that they have. The 100% owned assets, talk about Burlington Northern Santa Fe Railroad, Geico, National Indemnity Insurance Company, and Mid-American Energy, one of the largest energy companies in the world. They produce over 22 billion a year in operating earnings. And the publicly traded investment portfolio have like more than 320 billion in marketable value today. And they also have 160 billion in cash and short-term investments in bonds. So this is what I call the company is prepared for anything. The COVID came along, no problems. And good years comes along, they will accumulate more cash. And the stock price goes down, they'll buy back more shares. And somebody else's stock goes down, they'll buy back their shares. So this is the company that I would, if I have to force to put my 100% of my net worth in one business, this is the business that comes close to meeting that objective, because of both the safety and durability of the current businesses and the flexibility in allocating the future capital into future opportunities. To almost any measure, the company has like 900 billion in assets and maybe 400 billion in assets, 400 billion in liabilities. And both assets and liabilities are understated and overstated. What I mean by it, assets are understated because Geico is carried on a $2.5 billion purchase price in 1997. Burlington Northern Santa Fe's purchase price is $39 billion in 2010. So those two businesses alone are worth, if you compare with any kind of competition, they're going to be worth a lot more just because of their earning power today, not the future, just today. And that's the underrated part, understated part of their assets. There are two overstated part of their liabilities. The one is the insurance liabilities in a short-term nature. If the insurance liability, if they continue to write insurance to basically renew the customers every 6 months in Geico's case, or every few years in National Indemnity's case, and this is almost like a liability you don't have to pay, and the liabilities, insurance liabilities produces underwriting profits. They're pretty close to equity rather than a liability. The same way, they have a large, what I would call a liability, which is they have a large equities like a deferred tax liability. The company has to report according to the GAAP, and they have to report it as if we have to liquidate it, how much do we have to pay in taxes? But they're not going to liquidate it, and they don't have to liquidate it. So if you think about it, if these assets are going to be held for a very long term close to the perpetuity, that's pretty close to an equity. It's not a liability because it doesn't cost anything, and they don't have to liquidate it today. So just on the combinations alone, the equity value of 600 billion far understates both the assets and the earning power of the future. And I'm willing to take almost any questions after I finish this, and I hope I can come across difficult ones. Maybe I'll share the last business idea, and then we'll open it up for questions. The last one is Fairfax India. This company was set up in 2015 by Fairfax Financial, controlled by Prem Vatsa. Prem Vatsa was an immigrant to Canada from India. And so he runs this Fairfax Financial company for more than 30 years now. So they looked at opportunity in India. They have invested many years in India through Fairfax Financial. So now they see a lot more opportunities. So they set up a separate vehicle to participate predominantly in India through that vehicle. And they set it up in 2015. They have made series of investments over the last 6 years now. And they raised the money at $10 a share. And they've invested in almost $1.5 billion in the last 6 years. And today, the fair value, according to their discounted cash flow models, and in some cases, marketable securities, which are publicly traded, and they are carried on $3 billion today. And since there is a huge discrepancy between what they call a net asset value of the business, which is a little more than $3 billion, the market cap today is almost $1.8 billion. There's 40% discount. So the company is using excess cash to buy back their shares, which is exactly my type of model. And a lot of people prefer that discount to close, and then they want to punch out. Actually, I don't want the discount to close. I want the underlying business to get bigger and bigger and better and better. The discount persists for a long time. So our ownership and Fairfax Financial's repurchasing the shares would increase our ownership disproportionately. So I can answer almost any questions and individual questions.